Hello, everybody. This is Steve Bouchey. I thank Harmony Wagner for getting us up and going. I thank you for taking time out of your day to be part of another, what I feel, and sitting here with Marty and Ryan, a very good presentation, very timely. Obviously, we know the last couple of weeks have really changed the protection of the stock market. We saw a stock market that was kind of doing so all year long, and then the last couple of weeks we've had talk of rising interest rates, trade war, again today, rising interest rates in China, China's economy going down, and this is all affecting the markets, and we're going to address these questions today, or these thoughts that you may have with regards to the volatility. Let me start off by saying we're not concerned about the volatility. We think this will pass, and as we've said many times, we use volatility to our advantage as professional wealth managers. We like volatility. You may see us take advantage of some buying opportunities during this volatility. But let me get going here. Marty Shields is going to lead us off, and then we'll go back to some questions that were submitted, and I hope you enjoyed today's presentation.
Thank you, Steve. This is Marty Shields, and I'm going to start with presentation. As Steve mentioned, the last few weeks, beginning part of October, quite a bit different as far as the market performance than what we saw certainly in the third quarter, but we do want to do a bit of a recap on the third quarter. Let's get to the slide here. This slide basically shows the performance, the blue line, the S&P 500 for the third quarter, the orangish red line, the NASDAQ, and the green line is the MSCI EFA, which is developed international. For the quarter, U.S. markets hit all-time highs, both with the NASDAQ, the S&P 500, and small cap. They came down a little bit as the quarter ended, and in general, the economic data for the quarter was very good. In particular, consumer and business sentiment hit all-time highs, and the labor numbers continue to be very strong, while at the same time, inflation remains around the 2% mark, or depending on the measure, can even slightly below that. And in our quarterly market and economic overview, there was a quote from the Federal Reserve in there, and basically what they're saying is this is the perfect environment for strong growth, and really not an environment that's going to really push them to increase interest rates too dramatically. So we'll talk a little bit about that. On the next slide, just looking at performance of some more of the asset classes, third quarter, year to date in 2017. And although this was a good quarter in the U.S. markets, you can see that developed was positive, developed international, but emerging markets was negative again. And when you look at the year-to-date performance, really stark contrast between these asset classes. So again, real strong performance on the U.S. side, but negative performance for developed international markets, U.S. bonds, and commodities. So again, when we're looking across all these different asset classes, a real mixed story on performance. And then you compare that to 2017, and it's even more of a stark contrast where for 2017, developed and emerging markets, international equities really were the strongest performing asset classes. And you can see small cap, which year to date at the end of the third quarter was one of the strongest performing, whereas last year was a bit laggard. And again, this just shows you the importance of being diversified and not, when you see this underperformance year to date here in international, understanding that this could change fairly quickly, even for the remaining part of the year, but even as we go into next year. So diversification is very important. And just so you know, our current tactical positions, we've talked about this before, but our overweights are equities, versus bonds, and in particular U.S. equities versus international equities. We're overweight in technology, financials, healthcare and biotech, online retailers, small cap, and growth allocation. And we're underweight in utilities, telecom, consumer staples, and value. And as we look forward for right now, we don't see those changing too dramatically in the next quarter. So let's talk a little bit about bonds, because I think when we look at performance in a diversified portfolio, they have a big, they've had a big impact this year versus the last several years. So this chart right here basically looks at the performance, or the rate for the federal funds rate, which is what the Federal Reserve controls, and that's with the blue background, and that purple line is the 10-year U.S. Treasury. And just a couple takeaways from this slide, one of which is, although the market has really kind of reacted strongly in the last several weeks to rising interest rates, what you're seeing here is that the Federal Reserve has been raising rates literally since the end of 2015, and over the last 2 years, your Treasury hit up quite a bit. So, you know, again, what we say is, in the short term, the market can act very irrationally, and it's not as though this discussion of rising rates, both the Federal Reserve, Federal funds rate, and the 10-year Treasury, hasn't been out there. It's been out there quite a bit, but sometimes when the actual event happens, the market can really overreact to it, and I think that's what we're seeing right now with the market's reaction to the 10-year Treasury rising. But now when you look at performance, this is from September 8, 2017 to October 5th, 2018, of a number of different ETF bond funds. You can see that they're pretty much all negative for that time period. And this is what we've talked about. If you're going to be owning bonds in a rising interest rate environment, there is a very high likelihood of there being negative performance in those bonds across all different types of bonds. And what you see in this chart is that those bonds that have the longest maturity, so they're like the 20-year Treasury ETF or the 7 to 10-year Treasury, they have by far the worst performance. So the longer out your duration or maturity is, you have stronger negative performance when the rates rise. And one of the things we've been doing over the last number of years is trying to situate the bond allocation to mitigate some of that interest rate risk. This next slide just shows you the blue line is the Barclays Ag, and I talked about on your phone. You can see over the last several years the duration of the aggregate bond index, which is really the BARC index, has increased. And as that goes up, it means it's going to be impacted more dramatically by rising rates. Two of the funds that we've added to portfolios over the last month, where there is any bond allocation, are with floating rate funds or bond loan funds. And what you can see in the chart to the right is the aggregate bond, the duration is just under 6 years. Whereas the bank loan funds, or the floating rate funds, you can see it's on the very top in the dark blue. It's very close to 0 or 0.13 on the duration. And what that means is, as rates rise, if you have these floating rate funds, the interest yield that you will get, interest income that you will get, will actually go up with the market rate. And the impact on the price of the bond is almost negligible because of the short duration. And that's why we've made that change in the portfolios over the last month. This chart basically just shows you that although it can be a little painful as rates rise, over time, it is beneficial for anybody that owns bonds in a portfolio to have higher rate environment. And really all this is showing you, wherever your starting rate is, what is the overall performance. So if you're looking at the starting yield, that's on the bottom axis, and the actual performances on the vertical axis, you can see this is broken out by different decades. And not we've come off we're in the 2010s decade, and we're in the very low yield environment, and that means that the overall performance for bonds is also very low. But as you move up scale on starting yield, the overall performance increases. And as we said all along, if you have any holdings of bonds, having rising interest rates to get to a more normal environment, this is a good thing. Again, it may be painful in the short term, but being a long-term investor, it's beneficial to have yields actually go up. And I think we may have put this chart in here in the last webinar, but I think it's important to remember because until just over the last 2 weeks, I think a lot of people have been frustrated when they see the performance of their bonds, especially when U.S. equities are positive. But it's always important to remember, why do we have bonds in the portfolio? One is for income, and as mentioned in the previous slide, as rates go up, this is beneficial in the fact that the income that you receive will go up, but it's also about capital preservation, right? So although we don't think a recession is around the corner, it could come at any point, and we want to be protected, especially for those clients that are getting near to or in retirement. And what this graph shows you is the blue line is the performance of a 40-60 portfolio, so a fairly conservative portfolio with only 40% in equity. The light blue line is a 60-40 portfolio, and the green line is the S&P 500, and it shows you from October 07 all the way through almost 2015. And what you see is, that more conservative allocation has a much lower downdraft in the 08 financial crisis than either the 60-40 portfolio or the S&P 500. And again, for those individuals that are in retirement or getting close to retirement, it is important that we move through this time period of rising interest rates and keep remembering why we have bonds in there. And again, when we hit these times of volatility, that becomes more clear to most people. Okay, we're going to move on to concerns over recessionary fears, and Ryan's going to go through this part.
All right, thank you, Marty. And we're going to get into a little bit of some of the recessionary fears that are out there and some indicators that we're looking at as we determine, how much longer does this current recovery cycle and bull market have to move forward. So let's look at the last 100 plus years, going back 1900, and seeing the average recovery and recessionary timeframes. Average recovery, typically 47 months. Right now we're at 111 months, so more than double the average recovery. And quite frankly, recently, that's been one of the biggest reasons that many people point to why we're heading toward recession or why this bull market can't go forward. But we're going to look at some of the, the data and the factors that are out there right now that help us determine whether or not we are heading towards a recession anytime soon. So let's look at this. Households aren't over leveraged. This has been a great, pretty simple chart over the last 40 years, and it's a great indicator. Typically heading towards recessions, you see, individuals and consumers over-lever themselves, and this measures what percentage of debt service payments as a percentage of disposable income. As you can see, since the financial crisis back in 07 and 08, the consumer's been a lot better with their debt service and over-leveraging, and you can see that's relatively, after it dropped as much as it did, it's relatively flat in the lowest point it's really been over the last 30, 40 years. So that's a great sign for the consumer. I love this graph. It's a little hard to read, but the purple line shows you household net worth as a percentage of disposable income. The big thing with that graph, though, is that it's inverted. So when you see it going down, it actually means it's rising. And when it's going up, it actually means it's going down. And that green dotted line is the personal savings rate. And what you typically see is that household net worth as a percentage of disposable income goes up, as your home value increases, as you have more money with you, your savings rate typically goes down because you look at all your other assets that are appreciating, you're not saving as much. And that usually, that savings rate goes down, and it usually leads to, again, recessionary factors. Right now, that savings rate has pretty much stabilized. It went up for a few years after the recession and is by and large stabilized, which typically we see that going down as net worths go up. So again, this is a good sign for the U.S. consumer. We talk about the yield curve all the time, and I think on the last webinar we talked about an inverted yield curve. Right now, as the 10-year has gone up over the last couple of weeks, it's actually increasing that spread between the 10-year and the 3-month Treasury yield. So again, we're either stabilizing or getting further away from an inverted yield curve. Historically, again, the inverted yield curve has been a great indicator of heading into a recession. And again, this is just chances of recession currently low. So this is from the Federal Reserve Bank of New York. They've been fairly accurate in terms of predicting when recessions may increase and when the chances pick up. They are starting to go up a little bit based on their factors and their indicators, but it's still at around 15%. So still, I think, relatively low as we look at incoming other data that may lead to recession. And this gets into leading indicators. We talk about leading indicators a lot, and they may include bond yields, unemployment figures, new orders of goods and services, manufacturing. There's a lot of different things that go into what makes up leading indicators. But typically speaking, when you start seeing those leading indicators go negative, again, it's been a great predictor of when we head towards recession. So you can see the lime green part of the chart. As it goes up, that means leading indicators are positive. The blue that's pointing down, and you can see, the light blue highlighted in the chart is when we've headed into recessions. And again, this has been a great indicator of when recessions are on the horizon or when we're heading towards it. And right now, leading indicators are actually getting stronger at this point. To say that it's going to go on forever, but when you look at these factors, it's certainly not pointing towards a recession at this moment. Unemployment and inflation. So talk a lot about unemployment. Recently, a couple of weeks ago, the strong unemployment numbers, much like it happened back in February, like strong unemployment and increases to wages, is sort of leading to this fear of rising inflation, which would lead to rising interest rates, which, as everyone speculates, will lead to a bear market and a recession. But we look historically over the last 35 plus years, a lot of times when that unemployment figure matches up with inflation. So, as if inflation was at 3.7 and that's our current unemployment rate, inflation was at 3.7, we would get to a zero spread there. That's been, again, a pretty good indicator of factors. Inflation has pretty much hovered right around 2. We're not seeing a huge jump up in inflation right now, and even the last readings for September, inflation grew less than what economists had predicted. So we're not seeing this huge jump in inflation quite yet. If we continue to see unemployment get lower and inflation start to rise, I think that may be an indicator that we're sort of heading towards the end of this recovery phase. But as long as inflation is held in check, I think right now it's a good sign for the overall economy. And let's keep the big picture in mind. So this is the last, it's sort of an interesting chart to look at, but it goes over the last recessions over the past 100 plus years. And on the left side, you see the length of recessions. As we talked about earlier in those averages, the average recession is only 15 months. Very few have gone more than 2 years, really only the Great Depression. And you can see the magnitude of the Great Depression. That's that top left blue bubble. See on the far right side of the model that we point to is the most recent recession, where we had a 4% decline in real GDP going back to 07 and 08 during the financial crisis. But when you look at some of the other recessions that are sprinkled in there, the majority of them last longer than what we saw in 07 and 08 and have a less impact, meaning that it's a less hit to GDP. And I think what's important to remember here is that not all recessions are created equal. And we sort of have a recency bias of what happened in 07 and 08, and a lot of that with the state that the banks were in, which they're in much stronger position today, the state that consumers were in, and again, looking at the slides that we just reviewed, they're in a much stronger position than they were back then. All these are leading us to believe that we still have room to recover. But even if we were wrong, even if we were heading towards either a recession or a bear market, historically they haven't had as much of an impact as we've seen recently. So it's always important to keep that in mind. And not every time that we see volatility in the market is it going to mean that we're going to have a sharp decline like we've seen in the more recent bear markets and recessions. So where do we go from here? I jumped a slide. Okay, so I love this slide. I think this is really interesting as you look to market peaks and you go back. This reviews market peaks going back to 1945. So what it shows on the left side of the graph, 24 months prior, you usually see a 41% increase in the S&P heading into that peak. 12 months, 23%, 6 months, 15%, and 3 months prior, 8%. What it's showing, though, really is that you see some strong growth heading into market peaks. As we've said, right now we don't think that reached that point. So we still think that there's room to grow here, and we want to take advantage of the market growing from here. That's why we're so overweight some of the areas that we're overweight, because we feel these areas of the market are going to perform the best as we head towards the market peak. Once we feel as though we're starting to top off or get to that point, you may see some changes to the portfolio. But right now, we still believe that there's room to run. And as you can see, a lot of times towards the late stage bull market, there's a lot of growth in the markets. This is just interesting slide. For the last 6 years, we've hit market peaks in August or September. In 4 of those 6 years, we've seen pretty sharp declines right after we hit those peaks. We hit the peak in September 20th. We've seen some volatility since then. Just to show you that we've seen this before. We've experienced this volatility. Just because we're experiencing it today doesn't mean that we feel it has to be that much different than some of these past years. The election, we get a lot of questions about what's going on with the election, that we have the midterms coming up, and this is a really neat graph showing that usually in the years heading into the election cycle, markets have averaged being up about 1% into that early November election phase. Once you get past that, those last 2 months of the year historically have been up over 4%. It doesn't mean that the markets are going to coincide with that this year. But there is, when we talk about what markets don't like uncertainty. Heading into election, there is some uncertainty there. Once the election takes place, we know how the House is going to shape up. We know what the Senate's going to look like once the election is over. It removes some of that uncertainty, and I think that's where the markets do well after that. And I read an article actually a couple of weeks ago, Wall Street Journal showed that going back to mid-1940s, every year following a mid-year election cycle, which we're experiencing this year, the markets have been up. Again, it doesn't mean that historical norms are going to carry us forward, but I do think there's something to be said about the uncertainty going away and knowing what we have following these election cycles. And why diversification works. We talk about diversification all the time. A lot of times we feel over the long term, diversification works. It's to our advantage. We're seeing a year like this year where fixed income is down with higher rates. Um, International equities are down, driven by some of the tariff talks, strength in the US dollar. We're seeing where diversification right now maybe doesn't work in the short term. If you go over time, so that blue chart or the blue line is a diversified portfolio. It's made up of U.S. stocks, international stocks, and bonds. The green line is a 60% S&P 500, 40% Barclays U.S. aggregate, which measures the U.S. bond market. And the maroon line is just the S&P 500. So this goes back to December of 2000. Incorporates both the tech crash as well as the financial crisis of 07 and 08. And you can see, during certain times, 100% stocks are going to outperform, certainly. But it also shows you that if you're well diversified and you're building a portfolio to withstand market cycles, that diversification works to your advantage. It doesn't always work, and there's, like I said, there's periods of times where it works against us, but by and large, if you're investing for the long term, diversification is to your benefit. It's going to be your friend, and that's how we take the approach to portfolios. We're not going to overreact. We're going to tweak things at times, and you're going to see us do that, but we're not going to overreact. And I think that's important to remember as we go through those in periods like we've seen, especially in the last couple of weeks or last few months. So with that, if you want to look at our disclosure real quick, and we did get some questions from participants leading into this. So we have some questions we're going to go through and try to answer them. And as always, after this presentation is over, feel free to reach out to our office if you want to get into any more details on what we reviewed today.
Hello, everybody. Thank you, Marty. Thank you, Ryan. I think it was a great presentation. As I started off saying, it was very timely. Some questions did come in, and let's address them now. The first question is, the national debt keeps growing in leaps and bounds. Is there a benchmark for how large it has to go before it affects the markets, and what happens then? Ironically, I do a segment with Chuck and Kelly on WGY every Wednesday morning, and we talked about this. Our debt is out of control. The U.S. is spending more money than we're bringing in revenue, and it's actually a concern to be dealt with right now. Probably 6 years ago, Ryan, Marty, and I were in Chicago, and we had a great meeting and presentation by Bowles and Simpson, and we talked a lot about the U.S. debt. And the U.S. debt back then was scary. It's getting scarier. Unfortunately, nobody in Washington seems to want to address it in a way that they should. If it was their personal household, obviously, if you're earning so much money, you're spending more money than you're earning, you keep going in debt, you get to a point where you can't borrow any more money because the credit cards aren't giving you any more money. That's kind of where we're at. There's not so much a benchmark as we need to be more fiscally responsible, but it has to start in Washington, and hopefully soon we will really wrap our arms around that. The next question, how will the team adjust portfolios to a lower growth, higher rate environment? And I'm going to actually tie this in with the last question. At what level interest rate on a 10-year Treasury would we consider a reallocation from equities to bonds? Right now, we're still optimistic in the stock market. We feel that the stock market trades on fundamentals, and the fundamentals of the economy are good. We're putting more people to work. They're getting paid more with their hourly average earnings, and corporate America is earning record profits. Those are the fundamentals that the stock market looks at. There's a lot of noise in the marketplace, whether it be terror attacks, whether it be some crises over in the Middle East or other parts of the world, whether it be talk about oil embargoes, trade wars, rising interest rates. These are things that the market looks at, but really they trade on fundamentals, and the fundamentals are pretty good right now. As I started off saying, a lot of the headlines in the last couple of weeks were higher interest rates. Why does the Fed raise interest rates? The Fed raises interest rates because they want to kind of tap the brakes on the economy. They feel the economy is growing too fast. They want to slow it down. They don't want it to get out of control, because when the economy grows, that means we have inflation. With inflation brings higher prices in goods and services. Going back to one of the fundamentals, corporate earnings, corporate America loves higher growth rates because that means they're selling more goods and services. So I'm one that I don't look at higher interest rates as a negative thing. But when they first hit, and when investors think that maybe I should get out of the stock market because I can get higher interest rates in bonds, this is what we call volatility, part of the rising interest rate. So we believe that interest rates will continue to rise. We're not sure how fast, how soon, but we feel that there's more room for higher interest rates coming down the pipe. And I think when we get over this initial, let's say, shock of higher interest rates, the markets will kind of settle down a little. The other headline is China's slowing economy. That was today's headline. And the trade war. This president is bound and determined to make sure that the United States gets its fair share of what's going on around the world. And at the end of the day, as we know, Trump does things. Sometimes they're not a lot of diplomacy, not a lot of elegance. He almost takes us right to the edge of the cliff, and then everything's okay. Once again, we feel that the trade war will settle out at some point, hopefully sooner than later. And then the stock market can go back to the fundamentals, which means we are optimistic that the stock market will continue. As Marty pointed out, we're overweight stocks. Not only are we overweight stocks, we're overweight the U.S. stock market. We like the U.S. stock market. We're very underweight international stocks and emerging markets, and we're okay with that. We feel we get a lot of exposure with a lot of our mega cap stocks in this country because 50% of their revenue comes from selling their goods and services overseas. And then let's address rising interest rates. It's been quite some time since we actually loaded up on individual bonds and CDs. We will when we feel interest rates get to a point that they're attractive. The last time that I bought a lot of bonds and CDs for clients was back in like 2003 when we were getting 5, 6, 7, 8% good bonds and good FDIC insured CDs. Right now, we're very careful with our fixed income portion of the portfolio. We're making sure that we're in investments that we feel comfortable with, where we're getting a decent yield, even though if you look at the aggregate bond index, it's down year to date. People go to bonds for safety, but they're losing money in bonds. Our bonds are actually doing okay compared to the benchmark. We're very happy about that. So when we see the 10-year Treasury bond yield get to a point where we say, boy, that looks attractive, let's buy some bonds, let's buy some FDIC insured CDs for clients and keep them in the portfolio, that's when we'll kind of make that move. We're not there yet because we think that interest rates will continue to go up. And that last question, how have we invested in cannabis stocks? Well, we really haven't invested in this area. As you know, we're very diversified. We try to protect our clients, not investing in speculative investments, but we have had some clients that asked about these type stocks. In light of full disclosure, I'll be 61 next week. I have never, ever, ever done any drugs whatsoever. I've never puffed on a marijuana cigarette, nothing. But I'm hoping that investors that have gotten into these get high financially speaking, if you know what I mean. We have some clients that want to get into it for good old time's sakes, going back to their memories, we have others that feel that it's an opportunity. So we have a handful or so clients that have asked us about it, and we have invested in this area. There's an ETF that kind of collectively invests in a handful, not a handful, one of these companies, so you don't have to bet which company will survive or not. We know that this went legal in Canada. Who knows what will go on in this country and around the world. But it's an area that some investors feel there's opportunity. And for those investors that understand the risks come with investing in this area, we have a couple of investments that we feel will fit their let's say satisfy them being invested in this area. And it's an area that who knows where to go. But remember, it's a very volatile area. So being questions, and I once again thank you very much for taking time out of your day. I hope you enjoyed today's presentation. Stay tuned for the next, and we'll keep you updated if we see more volatility on the market. You know that we put together a nice letter and report which we emailed to you yesterday. We didn't mail it, but we're emailing it to you. So if you didn't check your email box, check for it. That's our quarterly letter. And obviously, if you would prefer us mailing it to you, just let us know, and we'll mail it to you rather than email it to you. Have a great day of our team. We appreciate you being with us today.